My friends, hello and welcome to episode number 3 of the Fundamental Finance course. We will continue talking about stocks and the operations we can do. I might show you in the next video, I'll do a screen share, I'll show you I've created a small portfolio, and then I'll show you a little bit. What are the possible and imaginable actions you can take with stocks? So when I go onto a trading platform, I can buy a stock, right? Careful. When we talk about trading platforms, we're talking about platforms that let you buy and fully own the stock. Why? Because there are a lot of platforms today. You'll find plenty, whatever you want, there you go. Some, for example, let you bet on a direction, on the direction of the stock. So in reality, you're not actually buying the stock, you're just betting on a movement. There are others as well that will give you what's called contracts for difference. That means instead of buying the stock, they're actually selling you a contract for difference. That means if you buy the contract for difference and the stock goes up, you'll be given money. If the stock goes down, money will be taken from your account. Here, I'm talking about the classic case where you actually buy the stock, it's yours, and you're going to keep it in your portfolio. So what we can do is buy. So I can buy the stock, buy, and I can also sell it. Now, there's an interesting detail about selling, which is that when I buy, well, I arrive, I have money, I've credited my account, click, I find a stock, I like it. Let's say it costs 50 euros, I want to buy 10 of them. I check, I have enough balance, I buy 10, and then after a few seconds, it arrives in my account. After that, well, there you go, I have 10 stocks in my portfolio. Simple so far. Now to sell, there's a little detail which is that I'm not required to own the stock to sell it. So I can take my 10 stocks, for example, and sell 5 of them, that's possible. I can take my 10 stocks and sell all of them, that's also possible. But I can take my 10 stocks and sell 20 or sell 30, or I can even go further. I don't have the stock at all, I sell it. So the sale, if I don't own the stock, that's called short selling. Short selling. So it's a sale. In the simplest view of short selling, that's short selling. Sometimes we say naked. Okay, naked short selling, naked. What does that mean? It means that, let's say the stock, today it's on the market at 100 euros. Okay, the stock is worth 100 euros. I look at it and I say to myself, you know what, that's too much for this stock. 100 euros, I think it's going to drop. I see these people taking a hit. I don't see it going up. For me, everything tells me it's going to drop. So what I do is I bet on it going down. So I go to the market and I sell the stock that I don't own. It can almost seem like a scam. Look, imagine you want to buy, I don't know, you want to buy a Renault Clio, okay? And you come in and you say, here, I want a Clio. So and so, you describe what you want, and then I say to you, listen, I can sell it to you. Why? Because the price you're offering me is such an interesting price for me. What I'm going to think is, well, I'll take the money and then figure out how to get you the Renault Clio, exactly matching your specifications. Okay, but as for Cote Argus, what you're asking for is 7,500 euros and you're offering 12,000. I'll just say, give me the 12,000. Okay, it's not a scam. I'm selling you a car. It's not a scam. The scam is if I don't show up, if I take your money and disappear, yes, but as long as I bring you the car that matches your specifications, it's not a scam. You see, it's completely legal. So I take the money, I'll manage, I'll find you the car and bring it back. In 10 days, I'm telling you, in 100 years, in 10 days, here you go, here's your Renault Clio. Great, awesome, you're happy, I'm happy, and I made a profit in the process. What's the risk with that? Here's the risk. The risk is that you give me the 000 euros and I promise to give you the Renault Clio. When I go to get it on the market, I can't find one for less than 15,000 euros. They're all at 15,000 euros. I wait, I try to negotiate, I try to look around, and then it goes up to 16,000. Now I'm really in a tough spot. I go see someone and they tell me, well, for me, it's 17,000, otherwise I won't sell it. I could end up, to get myself out of this situation, buying the car for 17,000 and giving it to you for 12,000. No choice. You see what I mean? I don't have a choice. That's just how it is. Stocks, it's exactly the same with short selling. So in short selling, What happens is that I sell shares at 100 euros. I don't need to actually have them. Later, there are two options that will come up. The stock goes down, but as long as it drops to 80 euros, if it drops to 80 euros, well, that's great for me. I make 20 euros per share. So what I do is I will automatically, through the system, buy shares at 80 euros and deliver them to you. And I keep 20 euros per share in the process. You see, I'm making easy money now. The risk, well, there's even better. Imagine. I knew the company was going to go bankrupt. That kind, it never existed. There's a sector that actually goes bankrupt. Let's imagine the stock starts at 100 euros, it goes down to zero, okay? Or it's worth 12 cents. Well, at that point, there you go. I can bring back as many shares as you want, and then I keep all the money, but that's very rare. Now, the risk with naked short selling, because there is short selling that isn't naked, but that's more complex setups. I'll talk about it another time. The thing is, if the stock goes up, look, here's a simple example, and this has happened to a lot of people. And actually, that's the fear of people who short sell. I used to short sell. At one point, I stopped because honestly, you want to sleep peacefully. The fear of short selling is this: you sell, then you go to sleep. After the market closes, the company that was worth 100 euros per share, well, there's a big competitor who announces we're making a hostile takeover bid. So a public offer to buy, when it's hostile, it means it hasn't been arranged with the company and all that. They go to the market, they tell people, you have shares at 100 euros, we'll give you 125. There you go, right away, easy money, come sell to us. So of course, people are very happy. They say, wow, 100 euros? Especially imagine the guys who got in at 90, at 70, at 75. Suddenly, you offer them 125, they're ready to sell, so they'll start selling at 125. The next day, you're in a tough spot, okay? And you realize one thing: there's no upper limit to how much you can lose because the stock can go up, up, up. So there you go. When do you short sell? Even though I advise against naked short selling, it's a tool that the market offers. It's not an obligation to use it. It's just one of the tools. Actually, imagine that you, in a situation, you think there's a bubble. For example, you say there's a speculative bubble. People are going completely crazy. For this type of asset, let's say you take assets related to artificial intelligence, you say it's not possible, it's a bubble. They're overvalued. You compare a little bit how much they've sold, how much money they're bringing in compared to their market valuation, all that. You say it's not possible. They're balloons, they're helium balloons, so you can short sell them. Except the problem with that is that you might be right. You have to be right immediately because timing matters. Because if now, let's say, you short sell Nvidia, which would be crazy, but we don't have any, you short sell Nvidia. Because you say at the price it's at $380 or 185. You say at this price, it's not possible. Nvidia, if tomorrow the bubble bursts, there's Nvidia. It will drop to $45 in a month. But yes, the problem is that you short sell it at 185. Then tomorrow they announce a big thing, a new card, a new deal, something, a signature. It drops to 195. At that point, you already start to panic because you've lost $10 per share. Then you go a bit further. It's at 205, it's at 208, it's at 211. And then what happens is that after a while, you have to get out because your losses are now starting to get very high. And your broker asks you either to add more money, which is called a margin call. He asks you either to add more money to cover your losses because now you're at a loss. You say you can stay, there's no problem. You've lost, let's say, $40 per share, and you've sold, let's say, 100 of them. So you're at a loss of $4,000. The broker doesn't care. You put $4,000 into the account. You keep holding them. There's no problem. If tomorrow it goes up even more and you're at $5,000 per share, $5,000 total that you've lost, add another $1,000, that's no problem. But the day you no longer have funds to cover your margins, you're forced to accept the loss. You're forced to buy them back at 220, for example, even though you had shorted them at 185. You see? And that's when you lose your account. The problem with that is when you get in too early, when you're too pessimistic and you get in too early in a short selling strategy, that's what can happen. And I've seen quite a few people do that. It's that you're right, but you're not aligned with the timing. That means it goes up to 220. Let's say Nvidia goes up to 220. You see, at 220, you're wiped out. It's over. You have to get out. You have to take your loss. That's it. You're liquidated. Then what happens with Nvidia is it hits 225. And then for 20 years, we'll never see Nvidia at 225 again. That means it reaches 225, then there's bad news, then there's a crash, it drops to 160, it drops to 120. It hits resistance at 100, then it drops to 90, then it drops to 70. After that, you see what I mean? So there, you were right. You see, you could have made a lot of money, except you didn't, because, well, you just weren't in at the right time. And in the market, it's not enough to just be right. Unfortunately, that's the problem. You have to anticipate two things. You have to anticipate your scenario. That means, is it going up? Is it a drop? But also the size. But it's like if I told you in soccer, you shouldn't just predict that there will be a goal, but you have to tell me at what minute the goal will happen. That's what makes intervening in the markets difficult. So we've talked about buying, simple selling, and short selling. Next time, we'll talk about leverage. Leverage is very important, but we'll do that in another video. See you very soon.